Okay, so before we connect with you, those are online. There was a issue in the system. So 3-4 minutes we are talking in the class. So the classmates is telling we're going to take some transactions and we can try to know how these transactions are going to be entered up to financial statement. It's very difficult actually, but we'll try maximum possible. Okay. How the transactions are recorded in basic books of accounts and how it is appearing in the financial statement. That's a job now. I'll just take it in the board itself, but I can't make assurance that they will see it. Board you cannot see it, those are online. Okay, then we will do it here only.
No,
Yes,
sir.
sir.
One second. Yeah, please. Now, what is visible for you? Those
Yes,
are
sir.
Yeah, it's visible now.
Yes, sir.
Yeah. Suppose first you are issuing share capital. Okay. Issue of share capital rupees 2 lakhs. You can see. Oh. Someone can please help me with this. I'm a little poor with this. It's not visible for you? Yeah. Okay, you will be seeing this in a while. Okay, we'll discuss. So we are starting a business with share capital of 2 lakh rupees. Okay, we are starting a business with the share capital of rupees 2 lakhs. What the entry you make for this? What is this meaning? You are collecting 2 lakh rupees from shareholders. It may be you and your friends and others also. Anybody who is investing in shareholders, promoter, co-promoters, founders, and others also. Others also. So now you are investing 2 lakh rupees, or you are collecting these 2 lakh rupees from general public also, including you. What's the entry? Bank account debit. Bank account debit to share capital. Share capital account. Okay. 2 lakh rupees. All right. Now with this, you are buying some machine. You are buying some machine. Buying machine. What's the entry? Buying machine for rupees 20,000 or 1 lakh. Yes, please. 1 lakh you are buying a machine. What's the entry for this? Machinery account debit to machine account debit 1 lakh to cash or bank. We don't have money in cash, so bank account. Okay. 1 lakh. Next, you are buying, buying some material. Bought goods. Bought goods for rupees 50,000. What's the entry? Purchase account debit to purchase account debit. You don't have cash at all. How do you buy from cash? Bank only. Purchase account debit 50,000 to cash 50,000. Like this will go on. Okay. Now, how this will appear in the financial statement? You have to prepare ledger account for machine, cash, cash in asset, bank, capital, okay, then purchase, sales, everything. Finally, to come to trial balance. Okay. Then this building, sorry, what is that? Machine. It will go to assets under the balance sheet. If you buy further machine, again you have to write the same entry, machine account debit to bank. When you have to prepare a ledger account of machine, you will have these two entries on the debit side. Two bank, 50,000. Sorry, two bank, 1 lakh. Then two bank, how much you are buying for that machine.
Sir, the spelling of buying is wrong.
Sorry?
Spelling of buying is wrong.
Which one?
Buying a machine. It's bubbing.
Okay, sir. Don't take that. Don't take that. Buying machine.
Okay, sir. Okay, sir.
Yeah. So, if you go to journal first, then you go to ledger. Okay, then you go to trial balance. Then you have to prepare financial statement. For example, what goods will be there in the trial balance debit side? Okay, then you go to P&L account. Cost of purchase. Cost of purchase. Right? If you have any wages, you give wage account, salary, rent, insurance. Actually, you're gonna big task for 1 hour course. So just explaining you how it is. You're not going to exactly. Okay, so you can try one on your own. Okay. But actually, we are not going to ask you this entire process as a question. It's a lengthy process actually. The company it takes 1 year. I believe. But you are accounting class, it takes 3 hours to do that. Okay. So whatever you have in the 6 hours, you're going to do it in a simple way. I mean, in single effort, but it is not possible. I should tell you how it is appearing. Okay, we are not going to exactly do what is the process. Okay, first journal entry is this one only. So for this, how do you make ledger? How do you make ledger? Suppose here ledger account. If you are making a ledger account, how do you make a ledger account? Debit side and credit side will be there. You have to make debit side take particular amount, credit side also take particular amount. Okay. Then suppose how do you enter this entry? Which entry? Bank to share capital. Suppose you are preparing a bank account, you'll have a debit side and you try to share capital account. If you're preparing a share capital account, you go to credit side of the share capital account, you write by bank account. Okay. Again, if the share capital is there, you have to write again by share capital. Okay. So whenever there is an entry for that account, you will have to make entry in that particular ledger account. Otherwise, no. Share capital normally will have only 1 entry or 2 entries. Every year, you won't have an entry. First year only, it will have an entry. Okay. Further, you will not issue share capital again and again. Okay. So that is a 1 entry. Okay. So we have to make all the ledger accounts. Then you have to close all the ledger accounts by calculating the balance. You know how to calculate the balance? Debit side, total, credit side, total. Comparing the 2 sides, and we can come to know the difference. That difference is going to be the balance. Okay. If it is debit side is higher, we call it as debit balance. In trial balance, you have to write that difference in the debit side. If credit side is higher, we have to write that in the trial balance credit side. So in trial balance, I told you there are 3 chances: income, liability, the one credit side, income, liability, and profit. So these 3 will be possible in the credit side of the trial balance. Debit side of trial balance may be asset, loss, expenses. By referring this, we have to prepare trading, profit and loss account and the balance sheet. Okay. So that much only I am able to tell you now. You cannot create again entire thing. You practice it, but in exam or any kind of question, you cannot get all these 3 together. Journal itself is taking some half an hour time. Ledger itself maybe another 10-15 minutes or more than that. then trial balance, then ledger account. I mean, financial statement. All these things together, you are not going to be tested, but you should be knowing all these three things. Individually, you may be tested. Individually, how to prepare journal. You are doing it in the assignment, right? Anybody would like to share the screen for our assignment? Anybody has done? Those who are online. We can take that as an example for 5 minutes. Anybody would like to share your screen that you have done your assignment?
Okay, sir.
Possible? Should I give permission for you for that? You try sharing your screen.
It's a disabled, sir.
Able? One second. The option will be there. No, you can allow them to share the. Sorry, no new share button for us only. For them. No, beside that. Which one? Aroma, there it is. It's a bit right side, huh? You can share all participants. Okay. Now you can try, sir.
Sir, please stop sharing and then I can, sir.
Stop sharing. So 1 year over, we just came out of this. We are given training for this, then we did for 2 years. Then now last 1 year we are doing only offline. Yeah, can you try now?
Sir, are you seeing? Are you able to see?
No, not yet. Yes. Can you go to the transaction? Can you go to transaction once? We are able to see your screen. Yeah. So first year, first May. Before that, anything is there? Can you scroll up? Okay, 1st April, Vikash Jaiswal, investment of rupees 6 lakhs. Okay, investment of rupees 6 lakhs. So what's the entry for this? Bank account debit to share capital account. Bank account debit to share capital account. Yeah, now he is getting the answer. We cannot write Vikash Jaiswal investment, and the general entry should be cash account debited to share capital. There's nothing called Vikash investment, nothing. Okay, we have tried cash account debit to share capital. You can correct it, sir. To share capital. Simply share capital. To share capital. To share capital. Whoever gives the money, it's a company, limited liability company. So you can just write share capital. If it is a partnership firm, you have write the name of the partner apostrophe A is capital. A is capital, B is capital, C is capital. His own money. Like it is raising money from some other person. Some other? Who is that? He himself is. He's borrowing. Yeah, kind of. Who is raising money? Himself. I mean, the owner of that. That's what. We are recording entry for who? See, he takes money from his friend, his wife, somebody else. What do you do? All the money. See, you are giving me some money. It is your money only. It can be your money. Whether you stolen, whether you got gifted, whether you earned, whether you take it from your parents, whatever it is. The money what you are giving to me is your money. For you, how it came is wrong. We are not worried about that. Company worries about how much money comes in company and how much money goes out of company. That's it. Now, who is the promoter? Maybe. Okay, in this case, promoter. You are promoter. Okay. Your company takes money from you. The company takes money from somebody else. Okay, all the money that comes to company from the shareholder is called only shareholder. That's it. Okay. It can be you or your fellow friends to whom you told your idea and they are ready to work with you and they are also contributing some money. You are also contributing some money. Okay. Suppose 5 of you are there, each 1 lakh are contributing. All the 5 projects promote. This is point of view promote. That's it. And again, you need further money. 5 lakh is not enough. You started. You find the business is going good. You want further investment, which you are not able to provide from your own pockets. That time, you are telling your idea to the public. If anybody is interested in your business idea and they are able to invest money in your business, you are welcoming them. They are also a part of shareholders, just like you. But they are just different from you in one point, that is, you initiated the business. You might have invested more than them. It is your idea. You may be getting the management also. You are together. They are scattered. You are telling the idea to the full Indian economy, Indian market. Anybody investor coming in giving money. That also the form of share capital only. So whenever you get money from the shareholder, simple bank account debit to share capital. So I did not open a bank account. First you open a bank account, then you tell the people to invest. You cannot just give the money in cash. Okay. You are giving 5 lakh rupees, each 1 lakh. From that money, you just open a bank account. Even first you open a bank account, 1 lakh of yours, real promoter who is starting the company really. Take 1 lakh rupees and you open a bank account, paying from 10,000 rupees. You open a bank, that's called registration of company. After registration, you can open a bank account. You open a bank account, bank needs the company identification number, CIN number, okay, PAN number of the company, and everything you have to provide. Okay, so, bank account debit to cash or cash account debit to, sorry, bank account debit to share capital or bank account debit to share capital, not without share capital. Just share capital. Then you can ask me a question. Sir, how do I know whose money it is? Vikash money or Vijay money or Vishwas money, how do I know? For that, we keep a separate register. That register is called register of members, register of shareholders. In that register, that's what accounting record. That's what accounting record. That register maintains the name, phone number, email ID, address, PAN number, bank account number, and all other required personal details of each and every shareholder, along with the number of shares, what they are having in your company, and also the unique number of the shares. Suppose Vikash is investing 6 lakh rupees. Okay, suppose one share is equal to 10 rupees. How many shares Vikash has taken from this company? 6,000. 10 rupees one share. Okay. 6,000. So the shares you have taken. Okay. So what number to what number? 0001 to 60,000. That you can record in the share register book. Suppose tomorrow, further you are getting some money from somebody else as share capital. You give a shareholder of the company. Bank account debit to share capital. Same entry. In the register, there will be another page open for him, the new person. Ravi, Rajesh, okay. So what's the number of shares? 1 lakh share, 50,000 shares, 20,000 shares, 10 shares. Number, unique number. Each and every share certificate will have its own number. And his PAN number, other data, Aadhaar number also. Suppose because he's selling the share to somebody else after a few days, we don't know anything about that and we don't do anything for that also. We don't worry about somebody selling the share or somebody buying the share among themselves. If the bank comes to me, only because money comes to me, I have to make an entry. If I buy my own shares from the market, I pay money, my share number comes down. Okay, so in that case, you have to enter. Otherwise, A sells shares to B. A was my share. I never worry about this. I don't even listen to that. When I will listen, the member register who is maintaining that, they will listen. When they will listen, if any letter comes to them, otherwise, how do they know? A sells the share to B. How does the company know about this? We don't know unless otherwise B informs us. Sir, I bought shares from Mr. A, who was not the shareholder of the company, whose share numbers are this. On this date I purchased, evidence for that is this. Change the name. Mr. B. I am the real owner thereafter. That letter should come from who? On receipt of the letter, by verification, then the person who is in charge of that register will change. But now that is out to share transfer agents are there, they will take it. The company that authorize somebody to do all this process. The company's job is something else. Your tire manufacturer, you have to keep tire manufacturing technology, market, supply, employees, strategy, many things are there. I am not sitting there just to make the entry of your changing your shares. If that is the case, every day some 1,000 people will change the shares. People are not there to just invest, they are just there to trade. Nowadays, people are very much creative, very much creative. Every time people are getting only, but today what happening? Instantaneously, you need benefits. Each one person, you will we will come first. The question are immediately, cost benefit immediately. If I buy the share, so when I get immediately after 1 o'clock some benefits, profits. That kind of people are there now. Trading. I buy. Not really wrong, but people are more in that category. So if you buy, sell every now and then, I cannot just. You come to separate people, so I'm outsourcing that process. Okay, come back to accounting. So now you know how to make entry for issue of share capital. Yes.
Normally we make the bank from debit.
How do you get money from the shareholder when they buy shares from you?
Say public, they will put it to bank. But if the owner itself is investing the money in the business,
Yeah, public is not owner.
they are also owner, but the promoter itself here, promoter itself is investing in the business. Is it necessary always?
Yes,
bank?
it is necessary. Why? If that kind of promoter is selling and using money in cash, he is cheating people. He is creating his own room for cheating people. You don't want to go to bank, what does it mean? You want to have every transaction in cash. That itself is leading to chances of fraud.
There is a can, but always it will not happen.
Okay, in bank it never happen, no. Why don't you go for fullest comfort? Nobody can doubt you. If you are having a chance of two, what is doubtful, what is confirmed? Why don't you going to a doubtful one. So, but you are giving room for other stuff.
I don't think we have that.
Yes. Income tax act says that more than somebody is working from account. Somebody, many of you are giving company. Your company is doing transaction in cash. Your salary is in cash. All bad. Everything through bank only. It's small. Not small. No, it is not. You are doing only in cash means you are hiding something from the government. That's what. Yeah, companies will do only. That's a small. I was saying small expense, petty expense. Cash should be there. Otherwise, how can you do it? Cash should be there. Suppose the coolie is coming, a portal is coming. You are telling, I'll give you one in cash. I'll give you your account number. Account number. Even come for that case, you have to give some cash. No matter. Okay. For that also, you have to keep some outside property. The cash transactions are mostly avoided. Okay. And again, even individuals, normal individuals also advise you to go cashless. I went yesterday cashless to a petrol point. You just fill the tanks. After filling, I was really getting panic there because I was just transferring money. It's not happening. In Google Pay or Phone Pay. Okay. My son, what he has done is data limit. Okay, I'm seeing it, that is on, data is on, everything is fine. But it is not working. I'm trying for times and the code of the documents. So I will share the data. Fine, it will do the message. So people are going to go cashless. One of India is looking for that, and already digital currency introduced. Okay, RBI has introduced. So it is the practice of any government to make you to have a habit of doing transaction only through monitorable way. That's one of the ways banking. So bank, therefore, without balance account run business, no. So bank is compulsory. The first person what you will do is you bring money. You bring money. From that money, you open a bank account. That money you put in the bank account. Okay, so very first entry can be cash to capital. Cash to share capital. Very first, maybe 1,000 rupees, 10,000 rupees. That can be. Later, his own money also will go to bank. But normally, what they will do is they do all these things unofficially without starting a company, without registering a company. They do all this process. Okay. This process, they will charge some money. That will become a share capital problem. The real promoters, what they will do, they do all this process unofficially. Unofficially means without registering a company, they do all these things. They buy land, they do everything. Then they convert that into a company. That time, whatever they invested in the normal business will become their share capital. Okay, that time the entry will be land account debit, land and building account debit, furniture account debit, all the asset account debit to share capital. When you convert your sole proprietorship or when you convert your partnership into company. So here, then you have to open a bank account. Then all money will go to bank account only. Okay, next, what he has done? Yeah. Can you go to transactions are also again? Yeah. Then again, any investment. See, transaction should be clear one. What you would write is received money from Anil by selling of shares. Same thing, investment. So entry will be first entry for second one, 1st April. Second, 1st April. Bank account debit to just share capital. Both are same date means no need of two entries. We can have only one entry. Bank account debit to share capital account. 1 crore, 1 lakh. 1 crore, 60 plus 40. Third one, again somebody is coming. Oh, okay, you have done all the things. So go to transaction first. Yeah. Look at this. 1st April, 1, row number 2, 3, 4, 5, 6. Yeah, 1 second. Wait. Yeah, up to 8. Okay, up to 8. Row number 2 to 8. All are investment only. Because all of them are different name. So all these can be one single entry. Only one entry. What is that? Bank account debit to share capital account combinedly how much? 24 lakhs, whatever the amount total. Okay, 4 lakh each from 1, 2, 3, 4, 5, 6. 6 into 4, 24, 24 plus 6, 30 lakhs. So simple entry, bank account debited to share capital 30 lakhs, being
Cash invested of
being
capital invested.
share issued to the promoters or being share issued. That's all. Okay. Next, come to ninth row. Ninth row, what is that? Cash given for company registration. Okay. We are registering into ROC.
Yeah. Company to bank. Company registration to bank.
And articles of association. Okay, and we are filing that with the register of companies and getting our name registered. For that, urgently, registration fee or registration expense or preliminary expense account debit to bank account. ROC will not collect cash from you. To bank account. You will transfer money to bank account. Okay. But this much may not be a registration fee. This 1 lakh may be for lawyer, auditor, those who are helping you to prepare MOA and AOA and other formalities. Okay. Anybody is owning a company here? Anybody has started in your name any company? It's very easy. If you go to MCA portal, you can do on your own. But people may need some kind of legal advice. For them, if you give money, they will do everything. They get your PAN number, everything, and they will do it for you. Okay, so all those things put together called as preliminary expense account debit. Preliminary expense account debit to bank account. Look at this, ninth row. We have to write preliminary expense account debit to bank account. How much is the expense for registration? Come back to the journal, transaction. Next one, what is that? Cash deposit to open a bank account. Okay, right. So if that is the case, if this is now only bank account is opened, means previous all things you can write it as a cash. No problem. It's academic understanding only. Okay. So bank account debit to bank account debit to cash. Bank account debit to cash. 1 lakh rupees. Next transaction. Purchased goods from the sports company. So purchase account debit to bank. Are you giving cash? If you are not giving cash, the sports company account. To sports company account. Yeah. Next. Like that, there are so many transactions. Still, you want to discuss the same thing? It's okay. No? All right. So you can stop sharing it. We can go to the next module.
Sir, could you please just show us once the ledger account details? Whoever is sharing this thing.
Yeah. Sir, can you again share it? If you have a ledger account. This is a ledger account. Look at the go to cash bank account, sir. Bank account. Yeah. Look at this bank account. Whenever you deposit money into bank, it will be written to the debit side. Suppose if you open a bank account, right? SBI bank account debit to cash. That's the first entry in the bank account. So look at the bank account now. Sir, can you little zoom it? Debit side to cash. 10,000 rupees. To cash, 10,000 rupees. Okay. Next one, you are again depositing into bank. To cash, 25,000. Whenever you deposit money, it will be in the debit side. Whenever you take money back from the bank, it will be in the credit side. Suppose there is an entry. Rajesh account debit to bank account. So bank account is in credit side. So I'll go to credit side and you will write by Rajesh. Look at the 26th transaction. 26th, column number E79. E79, if you see, by Ramana Sports, meaning you have paid 70,000 rupees through check or through online transfer to Ramana Sports. That is why it's coming on the credit side. The journal entry for this will be Ramana Sports account debited to bank. First. Bank account debited to. So Ramana Sports account debit to bank. Look at the journal entry is showing it. Ramana Sports to bank. When you prepare bank account, in the credit side, why I am going to credit side? Bank is in credit. Bank is in credit only. So I have to go to credit side of the bank. I am writing by Ramana Sports the same amount. Okay, look at this. By Ramana Sports. So this is how you have to make ledger. You have to make as many ledger as many in the journal. How many accounts are there in the journal? That many ledger you have to make. If Ramana Sports coming many times, one Ramana account. Ledger is nothing but classification of entries of accounts. Okay. Wherever Ramana is there, we bring all those Ramana together and we have to find out the net result of Ramana with us. Whether we have to pay money to him or he has to pay money to us. That we have to find out. Or his account is settled. We bought money, we bought goods from him and we paid off all of it. That case, no balance available. So for that reason, we prepare ledger accounts. So show me the trial balance also once.
What, sir?
Trial balance. Yeah, so look at this. This is a trial balance. All the balances of your ledger accounts will be appearing in the trial balance. All the balances. Whatever the ledger account that you prepare, but that are having balances that will appear in the trial balance. Cash account, look at this. How much cash you are having, sir? How much you are very rich. Cash rich company, your company is 25,64,000 rupees are having cash. Is it okay to have? Next semester you study. Okay, cash management, that is corporate finance, finance management. So accounting is nothing but the data entry job of the results of financial managers. If financial manager is okay to have 25,64,000, account doesn't have any problem. Accountant job is to just save keep the money and to save keep the entries. That's all. If he is okay for 25 lakhs, maybe next month there is a price fall in the raw material for that is going to buy. You can give that kind of specification. But anyway, normally it won't be there that much. Okay, what is the total capital of the company? 60 lakhs around crore. Okay, that's financial management. I think that for next semester. Now these all entries coming, all these accounts coming from ledger account. This ledger account is prepared, or more than this also. Any ledger account that is not having a balance, it will not appear in the journal. Any ledger that is having a balance only will appear in the trial balance, salary account, sales account. So in this particular year or this particular period of time, this company has sold 29 lakhs, sorry, 2,94,400 rupees only as sales. Maybe new company, no? So it's struggling for selling goods. Purchase, yeah, it has purchased for 7 lakhs. That is good one, yeah. You are buying for 7 lakhs, you have to sell it for 2 lakhs only. That's not good. Maybe stocks are still available. Next month we can sell it. So that is the entry here in the trial balance. Scroll down a little. Yeah, so this is the trial balance total. Debit side total, differential total, it should be equal. Okay, because of the double entry bookkeeping concept, it should be equal. It is equal here. Okay, that's it. I think we can move on to the next chapter. Yes. Which one, sir? Sir, just to hold on for a minute. Yes, sir. You can do, sir. Actually, in practice of the all customers will be having a debtors ledger. The debtors ledger, each and every name will be there. So finally, when you go to the individual customers, you go to debtors ledger. So when you bring it here, the trial balance, only single word, sundry debtors. Okay. Similarly, your suppliers, you have maintained separate name for your supplier. A bigger ledger will be there. In that ledger, the name is suppliers ledger or creditors ledger. Creditors ledger. Under creditors ledger, you have the sub account. Individual supplier name, supplier 1, 2, 3, creditor 1, 2, 3. when you bring to the trial balance, you can bring a group. Okay, sundry creditors. Instead of writing individual names, we can write sundry creditors. But the sundry creditors should be explained in a separate page. Who are all there? Sundry creditors. What amount is given from individual creditors? Okay, because sundry creditors 1 lakh. To whom I can go and ask? It is useful for next stage of accounting preparation. But for collection purpose, our collection department follow the data, right? So for that purpose, I need individual name and the amount to be collected from them. Okay, fine. Next. So you can correct that. If you did not submit, you can correct all these things. And I will cut 5 marks for you. Is it so? No. Okay. Next. Yeah. We can go on to the next one. Move on to the next chapter. Is it okay? Thank you, sir. Thank you for sharing.
So in the ledger, whatever the balance amount, the difference amount is there at the debit side, we can for that organization the cash or asset can be called. Or if it is credit side, then can be it is a liable to pay for that.
No, we cannot just say like that. Liability, debit side, any ledger account has a debit balance, 3 chances. It can be an asset, it can be a loss, or it can be a expense. Any ledger that has debit balance can be of 3 choices. You have to see the name. But in general, it can be an expense, it can be a loss, or it can be an asset. You have to see the name of the ledger account, rent account. Debit balance means an expense. Profit and loss account, having a debit balance means loss. Building account, having a debit balance means asset. So we can't just say as having a debit balance, it's an asset. No, it can be asset, it can be a loss, or it can be a expense. How do I know? Look at the name of the account. This next chapter is financial statement analysis. Financial statement analysis. Is it visible? I'm not sharing it. I will share it. Visible? I'm sharing a PPT. Yeah. So this is very, very important, not only academic purpose, or exam and all, in general, real life, very important. So far, what you have done, you understood what is accounting. Now in this chapter, you are going to understand how this data can be analyzed. Actually, we are doing there's no mathematics. Here it's just mathematics. Okay. Analysis and interpretation of financial statements. Why do we analyze? What is financial statement? You all know already what is financial statement. What are the financial statements? Okay, before that, we are going to discuss this many contents in this particular chapter called analysis and interpretation of financial statements. What is introduction that I am doing now? Meaning of financial statement analysis, need for financial statement analysis, the tools which are used for analyzing such a statement. One of the tools is ratio analysis. Okay, there are so many tools. We are going to concentrate only on one important tool, that is ratios. Okay, what is ratio? Meaning of ratio, definition of ratio, then classification of ratios, accounting ratios. Such classifications include liquidity ratios, capital structure or solvency ratios, turnover or activity ratios, profitability ratios, and then advantages and disadvantages of all these ratios. Okay, then we have to really compute such ratios, and we should know how do we interpret the answer of that ratio or those ratios. Okay, so these are all the various content what we have to learn in this particular chapter called analysis and interpretation of financial statement. So what do you mean by financial statement actually? What really financial statement mean to us? Anybody? To analyze something, you should know what is that, right? What can you analyze? This chapter teaches us to analyze the financial statement. So what do you mean by financial statement? Please respond.
The transactions of the company, position of the
Transaction position, okay? Then that's it. I ask the final question. Statement.
annual report.
Huh?
Annual report.
Annual report of the company's financial statement. Annual report contains the financial statement. But what is financial statement? A statement it talks about the financial position and the financial performance of an entity. Simple. Understand it. Don't think too much. Financial statement is a statement. Or if you are writing in plural, financial statements are those statements which are helping us to know the financial position as well as the financial performance of an entity. Yes. So what are the what are the financial statements? What are the various financial statements that we have, which will tell us about the financial position and which will tell us about the financial performance? What are they? Balance sheet, income statement, cash flow, fund flow, this is value statement, your billing statement. Cash flow, fund flow are not the financial statements. Okay. Tax statement. There are so many statements. We take only two here. Profit and loss accounts and the balance sheet. Income statements can be otherwise called as profit and loss accounts. A statement of income, a statement of profit and loss. Different words. In general, we call it as profit and loss accounts. A statement of profit and loss. Okay. Another statement is balance sheet, or you can call it as position statement. These two only have been prepared in last class. You remember? These two only we prepared. After trial balance, these two need to be prepared. Remember? After preparing trial balance, what is the basic objective of accounting? To know the financial position that is being achieved by preparing one of the financial statement called balance sheet. Another objective of financial accounting is to know the financial performance, profit or performance. That objective is being achieved by preparing a statement called profit and loss account. Profit and loss account is for knowing the profit or loss. Balance sheet is to know the financial position that contains assets, liabilities, and equity. Profit means difference between income and expenditure. Financial position means the sum total of assets, liabilities, and equity. How much a company and how much a company owes to others, and how much the company owes to its own owners. Its own owners, how much the company is owing is called equity. Net worth of the business. Book value of the owners lying in the business, or internal liability of the business. Okay, liability means external liability. Simple liability means external liability. How much the company owes to others? If the company is closed, how much amount, how much value that need to be settled by the company to the outside of the company? Maybe a bank loan, government dues, rent outstanding, salary payable to the employees, to the suppliers, etc. All those things are called liabilities, external liabilities. External liabilities. Both put together should be equal to asset. Suppose if I have money, that money might have been come from somewhere, maybe my salary, maybe my selling of some assets, or borrowing from bank loan. So the sources of a business at any given point in time should be exactly equal to the clients against the business by several people. By the several people includes owner, other than owner. Other than owner is external liability, owner is equity. Put together, look at the first example of this transaction. that person has brought 6 lakh rupees. Now 6 lakh in cash available. Okay, that 6 lakh is the resources of the business. 6 lakhs is at the disposal of the company. It's in the form of cash. What is the liability now? It is given by the owner. So it's equity. If the business is closed now, the 6 lakh is available to whom? The owner. Okay, so resources, cash, it is 6 lakh in our example, that is equal to the claim of the owner. Suppose next day you are borrowing 400 rupees from the bank. Your total resource becomes 10 lakhs. Cash in hand becomes 10 lakhs. The 10 lakh is given by 2 people. One is by the owner 6 lakhs, another one is 4 lakh by the bank. The 4 lakh from bank is called external liability. 6 lakhs from the owner is called internal liability. Our net worth of the business, our book value of the owner's claim in the business are just like equity. Don't confuse the word equity with only equity share capital. Equity is a common accounting term. Net worth of the business can be called as equity. It is for sole proprietorship also, it is for partnership also, it is for anything. Even an individual can have a net worth. Individual. Net worth. What is my net worth? Total my all resources available with me. Minus. What is minus? The all amount what I need to settle. Suppose I have apartment, the unit I have, worth rupees 1 crore. Okay, I have taken a housing loan of 20 lakhs and I have taken this apartment. Now the net worth is only 80 lakhs for me. So like that, it's for everybody. Equity, net worth is for everybody. Something like company else. Okay. So now, if you want to analyze the financial statement, you know what is financial statement? I told you. So what are the various financial statements available now for us? Only 2. One is statement of profit and loss, and one is balance sheet. Cash flow statement, fund flow statement, summary flow statement, all those things are not the financial statement for this category. So even cash flow statement, fund flow statement are the tools to analyze the financial. From the financial statement, I can prepare cash flow. From the financial statement, I can prepare many more statements. All those things are called as tools for analyzing financial statement. Okay, what are the users of financial statements? In financial statement, what I can find? I can find some numbers, data, some data. So, who are all interested in knowing about the data from that financial statement? We already discussed in the previous class. Users of accounting, we discussed. Who are they? Shareholders, lenders, suppliers, government agencies, customers,
R&D to R&D from agencies.
okay. Anybody? Employees. Okay, management. Okay. Public, general public. Then, so these are all the various people who are interested in your financial data, who are interested in your financial information, who are interested in knowing about your financial statement. Okay. What do internal users use it for? You told so many people, you know so many categories. Investor, general public, government agencies, R&D department, management, general public. You told me all of them can be grouped into 2 categories: internal users, external users. Now, my question is, what for the internal users will look for what purpose? The internal users of accounting information will look into the accounting information. What is the necessity? What is the use of accounting data for internal users? Who are internal users? First of all, employees, management. Why do they need accounting data? To know about their financial position. I mean, to know about their profitability. Okay, their performance, their efficiency. Okay, likewise, the external users. So now these internal users are in need of financial data for planning the future. To introspect themselves what they have done, how it has resulted in. Okay. Then Based on that, they can plan, they can evaluate themselves. Okay, and they can have a control over the company's operations. Just the postmortem report. Actually, accounting is a postmortem. Once it is done, only you are doing some entries. Okay, it's not a planning, but it helps what? Next future, next planning. It can help. Okay, next. What do external users use it for? What is the use of data, accounting data, for the external users? What are external users? Shareholders are external users? Are they external or internal?
For example,
For example, if they are in America, they are external. If they are in India, they are
for example, the person who is in public, he is not related to the company first. He is not related, but he wants to know the performance of the company.
What do you call it?
It's an external
What is called?
public.
What are you talking about?
No, but he wants to become a shareholder.
We are talking about who?
Shareholders.
Shareholder is public. Shareholder is a.
If the states become a shareholder.
That we are agreeing. Once you buy the city, you are getting this one. That's known fact. If you're just on the road, I can pull you here inside the classroom and I can't say it. Okay. Now, the student is internal or external?
Internal, right?
Shareholder is internal or external? No.
No, I am telling yes, sir. But
Then no problem. Then no problem. We move on. We say yes, we move on. We say no, we have business. Shareholders are internal. So why do they need accounting data management? Okay, there are internal. Why do external people? Who are external people? General public is external. Potential shareholder. General public. Or you are external. You are external for Tata Power. You are external for Tech Mahindra. Students, researchers, academicians. Vendors. Vendors. Okay. Vendor is external. Vendors. Okay. We are not connected to the business. They are dealing with the business. Okay. Fine. So all these bank were ready for you. Okay. So why do they need accounting information? They want to assess the past performance and current financial position and making predictions about the future profitability and solvency of the company, as well as to evaluate the effectiveness of the management. You are an external person. Why do you want to evaluate the management? I am going to connect with them for some reasons. Before I get connected with them, I want to know what they are. Who are they? What is their financial position in the past? What will be their financial position in the future? Maybe a bank before lend money to you. General public, before take your shares, before taking your debentures. As a vendor, before I grant some supply to you, before I give some goods on credit to you, I want to know who are you. What is your financial position? So for this reason, people are interested in the accounting information. It means what? Statement of financial nature or data, accounting data. Okay. Why do internal users use accounting data? Where accounting data can be found? Financial statement. Okay. What is financial statement? What is analysis? Statement we understood now. What is analysis? Very simple question, right? It's not accounting. Sorry? To understand, okay? What is analysis? They're asking you, are you married? You're telling I have 2 kids. Analysis leads to interpretation. Interpretation is based on analysis only. But sometimes the truth can be without also possible. Right? It's a process actually. Analysis, interpretation. It's the process. But some people may have interpretation without analysis. That's illogical. It is illogical, right? So what is analysis? Calculation analysis, okay. Anybody? So academic text is required, right? Planning. Okay. evaluation. So, in these three words, evaluation looks little better for me. Evaluating something is called analysis. Any other meaning analysis? It's not a coding. You are no. What is it? Analysis. You don't know accounts are happy, but analysis. Comparison is the process of analysis. Okay. Verification is analysis. Checking is verification, right? Checking. Analysis means assessing, evaluating. Okay, a deeper going into deep about a certain facts and figures. Analysis, the process of trying to find out a deeper insight about something, deeper insight about certain thing. That could be called as analysis. Analysis is a process in which a deeper insight on certain thing is intended before right before right. Okay, so analysis of financial statement refers to a process of a process of analyzing the financial data or connecting the relationship between two or three financial data, trying to find out the deeper insight about the financial data. Simple meaning, deeper insight, detailed inquiry of certain data. Analysis. Okay. If I want this analysis to be done, I need some data. Where I can find this data? I already told you that two statements will have this data, but in addition to that, we can have some more places where we can get from. Look at this. Information is available from published annual report. Somebody told that before annual report. Annual report is the only source. It is having everything about the company. Annual report. Okay, that contains financial statement, which is nothing but balance sheet and profit and loss account, and notes to financial statement. You remember in the last class we discussed about the note number 1, 2, 3, 4. Suppose in the financial statement, here we are finding a word called sales 10 crore. What is 10 crore? How these sales of 10 crore has been made? Total sales 11 crore, 1 crore is returned, sales return was 1 crore. Okay, total sales was 11 crore. Out of that, 6 crore was credit sales and 5 crore was cash sales. All this information may not be there in the income statement. If you want those data, the breakup of the sales, details of the sales, you will go to note to financial. One example. Like that, for every variable, what you are having in financial statement will have some explanation in the notes to financial statement. Then letters to stockholders, letters to shareholders. The MD or the management will write a letter. If you open a financial, report, annual report, the first 2-3 pages will be the message from MD, message from chairman, message from CEO will be there. So those letters you can have, from that also you can have some information. The auditor's report, financial statement is the outcome of the accounting, but that is being certified by whom? It is the competent auditor, qualified auditor, independent auditor. Okay, auditing firm. Okay, you are maybe knowing auditing firm. PricewaterhouseCoopers. Okay, and then there are so many. So those people give certificate for you. That report also can be used for getting some insight about the financial statement. Next. Last one, management discussion and analysis. Management themselves can have some kind of discussion among them, and they will have some kind of analysis. So these are the various places from which you can get information in the annual reports. Next one, reports filed by the company with government agencies. You are asked to file some reports with stock exchanges. Okay, ROC. Okay, those reports also will help us to find out the data about the company. Okay. So, on some other sources about the company, there will be an article in a newspaper, okay, or maybe a periodicals, financial information organizations such as some these investment banks or maybe some credit rating agencies. They will publish some reports. From that also we can get some idea. And any other business publications. If you are a tire manufacturing company, you cannot just analyze the tire manufacturing company's balance sheet and the financial statement. You should know on what circumstances this data has been in the company. You want to see the tire manufacturing industries. Industry itself performance, how it is doing. So for that, you have to read some business publications. Okay, Business World or any other journals and magazines you have to read. From that, you should understand the business of the industry. Today, the environment of industry, then you have to compare whether the company is doing good or not. Okay, so this is the basic introduction. What is that now? Break for some time.
45.
10:45. We break for 10 minutes. Okay. Those are online. We are breaking for 10 minutes. Then we can. Yes, sir. Thank you.
Hello, Aish, you are on video.
Okay, all right. Can you start? Those who are online, please hear me. Am I audible to those who are online?
Yes, sir.
Yes, sir.
Yes, sir.
The same PPT is visible for you, no?
Yes, sir.
Already received. Okay, so you all understood what is financial statement analysis. Okay. Analysis about the company's financial position and the company's financial performance. Why do we need this analysis? To know the deeper understanding about the company's financial position as well as financial performance. In this previous slide, you have seen, no? What is the need for that? In this slide, this is the need for financial analysis. Of course, why do people need such a need for financial analysis? First one is it helps in planning, it helps in evaluating the company's operations, and it also helping in controlling the company's operations. Similarly, financial statement analysis is helping us to assess the performance of the company, that is in the past as well as in the current. Okay, and also to make some predictions about the company's financial performance as well as the position. Okay. So like this, you have to make some points when it is asked what is the need for analyzing the financial statement. Now we can right away come to the tools for financial statement analysis. Horizontal analysis. What is horizontal? It's not an accounting, right? General talk. Horizontal means horizontal vertical.
Horizontally same level.
Same level. Horizontal. EMBA, BCom, BSc, or MBA, BCom, BSc. Same level. Okay. Vertical means EMBA, HR, what is what was the previous year? What is current year? Can be horizontal is same level only. Okay. Vertical means is vertical. Vertical. Okay, this is 2022. This is 2021. 20, 19. So horizontal analysis means you are comparing yourself in the same time period with others. Horizontal. Vertical means you are comparing yourself with yourself in different points in time. How I was, how I am. Okay. So there are two analysis. This is not tools to analyze. This is a type of analysis. It's what you are doing actually. Okay. Next. Common size statement. Common size. It's another tool to analyze the financial statement. Common size. What is common size? If you see the balance sheet, suppose you are having two companies' balance sheet in front of you. One company's balance sheet, the total of balance sheet asset side is 2 lakh. Another company's balance sheet asset side total is 5 lakhs. Your company's total is 2 lakhs. Big company's total is 5 lakhs. What total? Balance sheet total. Asset side liability. Both sides same only. Now which company is better? A or B? Answer me. Don't worry, there's no hard nothing. Right or wrong? What is your mind? What's on your mind, teacher? Big company is better. Why is that big company is better? Assets. So it is more than the top A company's assets. Okay. Can you say something like that? Can you say?
When we have the assets,
About many. One by one.
keeping assets is not only the
Company A is having 2 lakh assets, right? Company B is having 5 lakh assets. Can I come to a conclusion that company B is doing better than A? No. Why? Monitor. Yes. We are not discussing about profit. So taking only one consideration to the company is better. So that is not the correct logic. Okay. Anybody else? We don't know about liabilities. Liability also you know. Balance sheet. The balance sheet. Okay, you're talking about actual liability. We don't know about that. There will be some more information, sir, about the company so that we can decide which company is better. Okay. Company has more liability. Company has more liability. Okay, what's liability? We don't know about liability. What's liability? Asset is capital. Yes, exactly. So what is asking is we don't know what is capital. And also we don't know about how much is liability. We know only assets. You tell us about that too also. Then we come to know which company is better. So one small information about a company cannot be giving us a broader understanding of the company. So now common size statement means you are having 2 lakh rupees asset or 5 lakh rupees asset. You are converting each and every item into percentage. 100. Total asset is equal to 100. If total asset is 100, what is the value of bank balance? What's the value of stock? What's the value of land and building? What's the value of data? Different components, different variables, different items that are there in the assets of the balance sheet, as well as in the liabilities of the balance sheet, is brought into 100. Total is 100 means what was the proportion of asset to 100. Okay, that makes easy understanding about two companies. If you say I scored 75 marks, another person is telling I scored 45 marks. Who is A is scoring 75. B's mark is 45. B mark is 45. A's mark is 75. Who is a good student now? A is good student. He's telling A is good student. Is correct?
We should know out of what. So basically, maybe it is for 100.
See, understood out of 100. So, but Mr. Desa is not necessarily always out of 100. Now we are asking A, what is your mark? He's telling 75 for 100. We are asking B, what is your mark? He's telling 45 for 50. Now which better? So this kind of confusion won't be there. You should tell it percentage. 75% is the mark of A. 93% is the mark of. Simply we can say B is better than better performing than Mr. A in terms of mark. So that is possible when you bring all the numbers into a common term. Okay, that's called common size statement. Next, trend percentages, trend analysis. What was my sales in 2020? What was the sales in 2021? Now, what is the sales in 2022? Just to take one variable and taking, you can take any variable for that. The trend we can fit. Whether the trend is in upward trend. Advertisement expenses. It is an upward trend year after year. Is it good? Always upward is not good, depending upon what it is, what item we are discussing. Okay, sales is in upward trend. Profit is in upward trend. So we are analyzing the different data, different variables, different items in the balance sheet as well as in the profit and loss account by having a trend for each and every variables. Okay, trend analysis. The next one is ratio analysis. Ratio. That's what we're going to discuss in detail. Just tell me what is ratio. Forget about account. Somebody will mathematics, right? For mathematics. What is ratio? Ratio is proportion. Proportion. Okay. It's not about accounting. Actually, it's mathematics. What is your ratio of expenses to your total income? So I spend 90% of my income. I'm getting 1 lakh rupees salary. I spend 90,000 rupees. So my expense ratio is 90% to my income. Total income, my total salary. So it is easy to understand. Okay. So ratio is nothing but the mathematical relationship between two related variables. The two related variables happen to be an accounting variable. The ratio what you are calculating is going to be an accounting ratio. That's it. The ratio is not an accounting term. Ratio is mathematical term. Ratio is nothing but the mathematical expression of mathematical relationship between two related variables. If the two related variables are accounting variables, the ratio what you are calculating is going to be an accounting ratio. Say for example, company A is having a profit of 1 lakh. Company A's profit is net profit is 1 lakh. Company B's profit is 2 lakhs. So which company is performing better?
B.
B. Clear? Or anybody has it out? Are you okay to decide B is performing better? No, somebody is objecting. Why is not objecting? Company A has a profit of 1 lakh. Company B has a profit of 2 lakhs. He just like B made it better performing than A, but you are not accepted. Why? A has invested 5 lakh rupees and earning 1 lakh rupees as profit. B has invested 20 lakh rupees and earning a profit of 2 lakh. Now which company is better? Why? In terms of common. For 5, it is 1. So return on investment is 20%. Return divided by investment. Return is 1 lakh. Investment is 5 lakh. In terms of percentage, ROI in terms of percentage is 20%. Whereas company B has invested 20 lakhs as investment and is earning a profit of 2 lakhs. Return on investment for company B is adjusted. Then 10%. 2 lakh divided by 20 lakhs, 10%. So return on investment for company A is double the time of the return on investment of company B. The company A is looking to be a better performer. So like this, they are going to find out the ratios. Now what ratio I found out? Return on investment. I compare the return with investment. So ratios, mathematical ratios. We will discuss more ratios the time to come. So that is another tool for analysis. Okay. In addition to this, cash flow statements, fund flow statements, comparative analysis. Please write down. If you written this, you please write down that also in the list. Add to the list. Okay. Comparative examination. Point number 5 you can take as comparative statements. Comparative statement. Another one is cash flow statement. Last one is fund flow statement. Comparative statement, cash flow statement, and the comparative statement. Sorry, fund flow. Okay. So, same thing as in this tools for financial statements. How do you approach the financial statement analysis? There are so many tools available to analyze the financial statement, but the very powerful tool, widely used tool, industry accepted tool is ratio analysis. That's why we're going to discuss only ratio analysis. We already talked about this now. Using comparative financial statement to calculate rupee or percentage change in a financial statement item from one period to the next period. So now we don't want to come to this ratio analysis. Though there are so many tools, we in our syllabus concentrating only on. Okay, only curious people what is that? Other people tools. That's application of tool is only ratio. I already told you the ratio analysis meaning the expression of logical relationship between items in the financial statement of a single period. Single period. Okay, example, percentage relationship between revenue and net income. Same example, I told you ROI. Take another example. Revenue and net income. Your profit is 1 lakh for the first company A, 2 lakh is company B. Profit. How much sales we made? For the company A has earned the profit of 1 lakh for a sale of 10 lakh. For a sale of 10 lakh. Company B has earned the profit of 2 lakhs for a profit of for a sale of 50 lakhs. For a sale of 50 lakhs, company B earned the profit of 2 lakhs. Company A earned the profit of 1 lakh for a sale of 10 lakhs. 10 lakhs. Okay. Now you can compare these two companies, not in the absolute terms of profits. If you compare only the absolute term of profit, you simply say mathematically 2 is greater than 1. You simply say it's a company which is better. Mathematically it is true. But relative terms, for how much sale, 1 lakh is a profit. Just 5 lakh, 1 lakh is profit. 50 lakhs, 2 lakh is the profit. If you break them into percentage terms, then we can come to know what is a real company doing better. So that is what we call it as between revenue and net income. Or you can take any such percentages. They should can be expressed in terms of percentage, number of times. Number of times. It can be expressed in terms of decimal. Okay. So there are so many ways in which you can express ratios. Okay. So this is nothing but percentage. Here is example given as percentage. In ROI also percentage from. Okay, let's take an example. Sales and net revenue, sales and profit. That's also percentage term. For 5 lakh sales, 1 lakh is the profit mix as a percentage. But percentage of profit is 20%. For a sale of 100 rupee, I'm getting a profit of 20 rupees. In another case, 2 lakhs is the profit for a sale of 50 lakhs. So 2 by 50 into 100. That's percentage. So, okay, like this, you'll be having a statement, right? You already know this. We already prepared last week, last class. Okay. Now I switch over to our own another file. This is little elaborate. We'll go to another file. Are you able to see the PDF file? Those are online.
Yes, sir. Yes, sir.
Look at this. These are all the various ratios, probable ratios. You can find out your own ratio, no problem. But in industry, people have already had some ratios which are applicable to all the companies. One caution for all of you: if you apply ratio analysis for any data, okay, say for example, you are going to a doctor. Doctor is sitting in the 7th floor. Lift is not working. You are going with stairs. Reaching the doctor. Immediately checking your pulse. Okay. He is telling it is unusual. You are having blood pressure or something. It's unusual. 72 to 90 is normal, but you are having 100 to 150. Please take it to ICU. If you stay like that, it is illogical. What is the meaning? Why I am telling this example here? You are all doctors now. For whom? For patients. Who is your patient now? Companies are your patient now. Before you prescribe anything as a doctor to your patient, you should confirm that the prescription is correct. Simply you are having some tools in your hospital. You cannot tell the patient to go and take a test. Many may do, but it is not correct. If you are having a headache, you take a tablet for headache only. But now reverse you are doing. You go for a higher treatment first for headache. Okay, you want to take a CT scan. Nothing is found. Come to the next level. Nothing is found. Come to the next level. Okay, now nothing is found from all the 7 levels. So it may be a normal headache, sleep is awesome. If you do so, of course, maybe you are taking care of the patient in so much good manner, but it is not always desirable. First, think for the basic one. If it is not, but time elements. How much time it takes? By the time you reach the last level, maybe severe accumulation. Both your concern. Why I am giving this example for this accounting ratio series? If you go by number, it may sometimes mislead you. The example I told you 7 flows you are just climbing and coming. After that, you have to ask him how did it come, please take rest for 5 minutes. Then you have to take a measurement. After that, if you have an unusual measurement, you have to ask some kind of questions to him. Then you will decide. Simply, you cannot. So, net profit ratio is 20%. Average ratio for higher industry is 25%. But this company is only 20%. This company is not doing good. You cannot write that ratio like that simply. You have to ask him, which year it is? 2019, 20. Pandemic year. No car was sold, no car was running, no time was sold. Okay, 20% achieved. Your average is 25. To achieve 20 is good combination. So what I'm trying to say is numbers may misguide you, mislead you. So before you take a decision on number, ratios are nothing but numbers. All ratios are going to be giving you some final number, percentage, times, decimal, something is going to be calculated. Based on the calculation, you have some standard also. If you compare the real for the company with the standard of the industry, before you take a decision, you should think twice, thrice, you have to analyze, take qualitative aspect also into consideration before you do any corrective measures for that. Is clear? Now, what are those ratios in general available for us? The ratios can be classified into liquidity ratios, leverage ratios, activity ratios, and then three. Okay, liquidity, leverage, and activity. What are the liquidity ratios? Liquidity ratios are helpful for finding out the liquidity position of the company. What is liquidity? Liquid means liquidity.
Current available cash, for example.
Anything that can be accounting meaning, chemistry meaning, solvency, solvent, insolvent. What is that? Solvent, insolvent mean same thing. Something that is dissolving some liquid. It's not solvent. Okay, it is not dissolvable. It's not insolvent. Same thing here. Financing position. Liquidity means are you able to pay off your dues on time? Suppose every month, first day you have to pay rent for your office premises. Are you able to pay? That is going to be checked by some of the ratios. How much you are solvent in short-term position, short-term requirement. That's called liquidity. Short-term solvency is called liquidity. Long-term liquidity is called solvency. Solvency means in long run, how are you able to manage your payments? What are long-term payments? Loan you borrowed, you have to settle 5 years, 10 years, 20 years, loan you borrowed. How are you able to repay? Are you able to repay? That is going to be checked in one ratio, that group of ratios are called as solvency ratios or leverage ratios. Leverage means what? What is leverage? In English, leverage or leverage. Doing something by applying some tool, otherwise it will be difficult. Doing something is by applying some tool, otherwise it will be difficult. Simple example, those days in the well, if you want to take water, if you take water from a bucket by rope, you take it into heavy, you cannot just, you take it directly, heavy. But same time, if you apply that rope through a wheel, a small wheel kind of thing, that wheel is called leverage. If you pull rope through on the rope or through the rope, the bucket weight, the water weight, you cannot feel that much. You will feel it easy and quick, you can do it. Instead of doing it directly. Similar thing, that's called leverage. The wheel is leverage. What is your leverage then? Doing business by your own money is risky. Borrow as much as you can, do the business. Pay only interest for them. You are borrowing 100 rupees, buying goods for 100, selling it for 120. What's the profit? 20. Interest, the bank is only 8%. Remaining 12 rupees for you. So this is called doing business by borrowing money. It's called leverage, financial leverage. Doing business by borrowing money. It's called financial leverage. But it is discovered. You are borrowing 100 rupees, buying material for 100, you are selling for 90. You are able to sell only for 90. What is the loss now? How much is the loss now? 10 is wrong. 8 is correct. You are not correct. That's it. 10 is loss, you cannot take loss. 18 rupees loss is 500. You have to pay 8 rupees interest for the bank. If you have not done the borrowing, it's your own money means what loss is. So the two sides of the spots. Borrowing, doing business is good. Same time, this is good. You study, continuation to this, the next semester called corporate finance. Now we are going to check a company how they manage their finance of getting loan or their own money. That is going to be checked in a ratio called solvency ratios. Are they solvent in long run? Are they able to repay the money in long run? That's going to be checked in solvency ratios. Okay. Next, activity ratios based on your profit. Okay. If you see how your performance, how are you converting your cost into, product into sales. This is the last one. This is another separate ratio, profitability. Okay, we'll discuss here in the, yeah. Look at this. Yeah, this is giving you some clear idea. This is giving you a detailed information compared to the previous chart. This chart gives you the detailed information about ratios. Look at this. Short-term solvency, otherwise liquidity. Long-term solvency, otherwise leverage, activity ratios, and then profitability. 4 broader categories, 4 families of ratios, 4 group of ratios we have. I repeat again: solvency ratio, liquidity ratio, activity ratio, profitability. But all the 4 may have different names also. Don't confuse with that. Look at this again. Liquidity ratio, otherwise called as short-term solvency. Long-term solvency ratio, otherwise called as leverage ratios. Activity ratios can be otherwise called as efficiency ratios or performance ratios or turnover ratios. What I am doing here is you are comparing your sales with all other variables. For 1 rupee of sales, what is the expense? For 1 rupee of sales, what is the profit? For 1 rupee of sales, what is the employee cost? For 1 rupee of sales, what is the purchase cost? What is the interest? You are comparing all your other items to sales. Turnover means sales. Turnover means sales in accounting. Okay. So that is called efficiency. How you are efficiently managing your company in terms of finance, in terms of regular activities. That is being captured in some group of ratios. Those ratios we call it as activity ratio or efficiency ratio or performance ratio, otherwise called turnover ratios. The last one is profitability ratios. Each and every group of ratios are having its own purpose. One is not a substitute for other one. It's all having its own purpose. You are going for a walk, you are playing. Okay, the basic idea is taking care of health. So all these ratios are taking care of the health of the company. Is a representative of or indicator of the health of the business. But it's having its own purpose. Okay. So this is compared with capital structure. What is capital structure? Structure in which you make up your capital. What is capital? The total amount required for the business. How are you arranging that money? Whether you are getting from shareholder or you are getting from debenture holder or from bank. 2 capital are there. One is owned capital, other one is borrowed capital. Okay. The relationship between these two is called capital structure. Suppose my company needs 100 crores as capital. 100 crores as capital. You are arranging 60 crore from equity share. 40 crore from debenture holder. What is debenture? Borrowing from general public. For them, I give some acknowledgement of certificate. The certificate is called as debenture certificate. Or loan. I'm taking loan from bank. Both are coming at the same category called debt capital, borrowed capital. Another one is owned capital or ordinary capital or capital. Okay. Now the relationship between these two is called as capital structure. If more the borrowed capital, more the financing risk the company is. At the same time, the earnings of the company is going to the shareholder if the company is in the profit side. If it is the loss side, they will get more loss than the other actions. For example, 10 and 18. Okay. Next. Coverage ratio means how much you are able to cover the interest what you are going to pay on the borrowed capital. If you have borrowed capital, you have to check how much profit you are earning every year. Are those profit enough to pay off the fixed income charges? Fixed income charges. If you borrow from the bank, 850 you have to pay. Whether you earn profit or no matter, you have to pay the interest. That's fixed charge. Bank will not come and ask you, so you have 20 rupees profit, you need more than 8. No charge. You are not going to pay more than 8 or less than 8 irrespective of your current stream, profit or loss. Fixed charge. Debt capital demands you to pay a certain fixed amount of interest every year, irrespective of your performance. Whether are you able to cover that fixed income, for them it is fixed income or it's fixed cost. Okay, whether you are able to cover that interest at least in your profit every year. In my example, I told 8 rupees of interest. Out of 100 rupees, I am earning 8 rupees at least as profit. After covering everything except interest, I am able to earn 8 rupees. So, you are able to earn 8 rupees, okay. Go ahead with the borrowing. If you are not able to earn 8 rupees, you have to pay interest out of your money, out of the capital. If you do so, one fine morning, the entire capital get eroded. You cannot pay interest out of capital. You have to pay interest out of generating profit. So that is being analyzed here. Then liquid profitability ratios, how your company is profitable in terms of sales, how your company is profitable in terms of investment or any other equity or any other valuation of market, how much your company is earning profit. You are buying a share from a company, how much you are going to get back as earning per share or dividend. You know dividend, right? Dividend. So this last one is market related ratios. As a shareholder, I am buying a share of a company by spending some 1,200 rupees, waiting for 1 year. After 1 year, how much I am going to get as dividend from that company? That is being checked in market ratios. Okay. We will see one by one. These are all the various liquidity ratios. What are they? Current ratio, quick ratio, cash ratio, and then interval ratio. Last one is net working capital. We will discuss only the three. First to third. Okay. We'll discuss only three. This is there your LMS. Just we can understand what it is. Okay. Current ratio. What is current ratio? Current ratio is equal to the relationship between current assets and current liabilities. Current assets and current liabilities. It is expressed in terms of times. One time of current asset is expressed by how many times of current liabilities. What is current asset and what is current liability? Any asset that can be converted into cash within one accounting period of time is called current asset. Any liability that needs to be settled within one accounting period of time is called current liability. Example for current asset is, look at this, inventories, sundry debtors, cash and bank balance, receivables, loans and advances given by our company to outsiders in short term, disposable investments, any other current assets. These are all called current assets. Where you will find this value? If you want to calculate current ratio, we need current assets, the total of current assets of a company. Where you find out these values? Balance sheet. So the ratio will be otherwise called as balance sheet ratios. We can classify the ratio into two categories: balance sheet ratios, profit and loss account ratios, combined ratios. Some people will divide it that way. Any ratio which can be calculated by taking the variables only from balance sheet is called as balance sheet ratios. Any ratio which can be calculated by referring the data only from P&L account can be called as profit and loss account ratios. Any ratio which demands the data from both, some from balance sheet, some other variable from balance sheet, that ratio, those ratios can be called as combined ratios. But that classification does not give any meaningful information. Where you take the information, that's a point of discussion. But these ratios give some detailed understanding about the company. So what is current liability? Any liability which can be, it's demanding you to repay, settle in one accounting period of time is called current liability. Example for current liabilities: creditors, short-term loans, bank overdraft, cash credit, outstanding expenses, provision for taxation, proposed dividend, unclaimed dividend, and any other current liabilities. So, if you are given with the balance sheet of a company, you should take this information from the balance sheet and you have to add these separately, current assets separately and current liabilities separately, and you will divide them. Divide the current asset total by total of current liability. You will get one number. That number is called current ratio. What is the understanding we have to make from current ratio? Look at this. Any company whose current ratio is 2:1 is taken as a standard one. They are okay with the liquidity. The company is enjoying liquidity. No problem. What is 2:1? Which is 2 and which is 1?
Second. Correct.
Asset is 2, liability is 1. 2 by 1 or 2. Current asset 2 times of the current liabilities. That can be put. Suppose a company is having 2.5:1. What is the interpretation? 2 good is that's why 2 good. Anything is too good. Anything seems to be too good is not really good. Somebody is coming in. Yeah. Yeah, we start. Okay, maybe. Suppose I'm going to tell you, give me 100 rupees, tomorrow I'll give you. Looking very good. Looking very good or not? Looking very good. It is looking very good. So who else maybe? Suppose Modi coming and telling you, give me 100 rupees, tomorrow I'll give you 1,000 rupees. Looking good. Anybody who's coming and telling you looking good. But looking too good is nonsense. Why it's not good? Which idiot does because nonsense will give for 100 rupees of today tomorrow? No doubt. Maybe somebody is giving good. But doubt element is automatically coming. If anybody is describing something, very good features about something. The airport is going to be next to your door. Okay. I mean, fourth is going to be back side of your door. Okay, railway station is going to be there. Or 1 square feet is equal to 1,000 rupees. We are selling it only for today. Amount of checks. Come and check. Come with the pre-paid check. Looking good, but it is not illegal. Maybe sometime airport and aerodrome, port and railway station may be nearby, but not on the side. It's too bad. Video is not there. So 2.5:1 is equal to not good. Why it's not good? You are unnecessarily keeping cash with you. Unnecessarily keeping so much of money in the current asset. 2 times is okay. 1 time of liability can be represented by 2 times of asset, current asset, including cash. But you are maintaining more than that. You are obviously expecting you to work only up to 5 lakhs. Every day you are looking up to maybe in a PC employee or overtime. If they pay it is good, otherwise, to be there. Similar to that. You are unnecessarily locking up so much of the resources in current assets. Better divert them into some investments, earning money. Likewise, other one, 1.5:1. 1.5:1. Not good. They're having a problem. What problem they have? They may have a liquidity crunch. Landlord is coming and asking the rent. You will say, sir, please come and sit, take a coffee. I want only rent. No, sir, take a coffee. Meaning, you are going to tell you, come tomorrow. I will give you tomorrow or something like that. We'll deposit. Sir, give your account number, we'll deposit. He will tell, I already given you the agreement. Account number is there, you want to deposit. So that kind of problem is illiquidity problem. That will give a problem of believing your financial health. If you go and ask somebody else, sir, give me some stock, I will pay you later. This message already went out stated. Or he will go and check your current ratio. He will come to know 1.5:1 is there. So this company is not having a proper liquidity position. So I will not give some supply for the market. Okay. You know how to calculate that? You will do it later.
So basically, for example, if the company would plan that tomorrow. Okay. Right. So it is to ensure they have the what do you call it? To cover the losses, they have the asset.
No. Why do you? The last analysis is not discussed. It's only about the two different assets and liability. Profit is not a matter. Profit we are not talking. That's what I tell you. For fever, what test you have to do? For cancer, what test you have to do? Tests are different. This test is only for your current liquidity position. Are you able to pay? your current liabilities or not. That's it. To find out the profit, the company is profitable or not, you go to another issue called profitability ratios. You have an idea. All profitable companies may not be or not receiving the liquidity. All liquidity and companies may not have higher profitability. Actually speaking, these two are two extremes. Liquidity will hamper profitability. Profitability demands illiquidity. What's the meaning? If I say my owner has come next month, if the owner is very good, okay, so I don't have money, but I can take it from next month. That 1 month, that 1 lakh rupee, you can just do some activity. So liquidity is hampering the profitability. Profitability demands illiquidity. My speaker used to tell like this long back when I was studying finance and management. Answer receipt. Dealer payment. If anybody has to give you money on 10, 6 o'clock morning, 6 a.m., go and stand in front of me, give me money. If anybody has to receive money from you on 10, you switch off your phone up to 7:59, 12 o'clock you switch off and transfer. But that was the attitude of the people long ago. People now you are aware in the business. Okay, okay. Traditional way of financial management is delay the payment as the result. But it depends. If you always do like that, people are market is always very knowledgeable. It will sense what you are doing. Then if it is spread across the industry, you will be having a bad name. Okay, so come back. Next one. Second component of current ratio is the liquidity ratio is quick ratio or acid test ratio. It is having little more stringent measurement of liquidity. The first one is little broader measurement. We include all the current assets, all the current liabilities. But here, the current assets excludes two things: inventories and prepaid expense. Same thing. You are not including inventory amount and prepaid expense amount in the balance sheet with the current asset. If you don't include that, is called quick assets. The formula is quick ratio formula is quick assets divided by current liabilities. The denominator remains the same. The numerator is coming down. Actually, excluding two components from current assets. So it's called a little more stringent measurement of liquidity. That is called acid test. Acid test ratio or quick ratio. Right. So what is the interpretation for this? 1:1. Look at that. We also reduce that from 2 to 1. Since two assets are excluded, we are giving some different standard. It's called standard ratio. Standards. 1:1 is standard. If you have more than 1:1 or less than 1:1, you are having some trouble. You have to look at it. Next. Third one is absolute liquidity ratio. Absolute liquidity ratio, otherwise called as cash ratio. The formula is cash and bank balances plus current investments or marketable securities divided by current liabilities. It is little more stringent measurement of your liquidity. Absolute liquidity. You see, inventory is there with you. Can you sell it immediately? We can't. Debtors are there. Can we collect the money immediately? No. They have their own schedule. On that day they will give. So to have more liquidity, we have to look at only cash balance, bank balance, which is at your disposal at any time. Plus marketable securities. You can sell that anytime in the market, in the exchange. Okay, or any other current investments divided by current liabilities. Okay. So what is the interpretation you can give now? The absolute liquidity ratio only tests short-term liquidity in terms of cash and marketable securities. What should be the standard ratio here? Standard ratio? Huh? If you want to have 1:1, not possible. 1:1, not possible. Now your liability will be more. So far your assets were more. Now we include all the assets possible. Only liquid assets you have. Most liquid. You have. So you cannot have 1:1. 0.5 is 1. 50% of your liability is in the form of liquid cash. See, these are all standards actually. You are having in medical level standards on the sugar level, on the blood pressure level. We have weight and height. We have standards. 178 in the height. You cannot 78 as well. Weight maximum. Suppose there's a person. He is 180. Height 180. See that? 180. Yeah. He is having only 58 as a weight. Yeah, weight 58. You cannot immediately take a conclusion that is underweight, prescribe something for increasing it. Like there are so many people standing in the park in the morning, right? Okay, free, something like that. Okay. You cannot follow it. It's hereditary like that. The standards, medical standards are all fixed in average. Okay, average. Europe, a person, what is his weight and weight? In Asia, what is the weight and weight? May change. Even within one country, within one continent, the heredity of one group of people may change to another group of. So you cannot go with just the number age of the point. Okay. So one company has 0.75 is to 1 as absolute liquidity ratio. We cannot immediately come to conclusion that it's done more. Okay, but you have to check what it is. Okay. Next one. Yeah. Leverage ratios. Next broader getting. Only in that we have discussed only 3. First one, liquidity.
So
Current ratio only 3.
quick ratio, what should be the ratio?
0.5 is to 1.
That is for cash ratio.
Yeah.
Quick ratio.
1 is to 1. Next, point number 2. Major point number 2. Solvency ratio. So far we discussed about short-term solvency. Now we are talking about long-term solvency. Who will be worried about short-term solvency?
Yes.
Mainly suppliers. And the bank, which is granting you overdraft facility, cash credit, short-term loans, they will be worried about short-term solvency. Next, long-term solvency. Who will worry about this?
Bank.
Who are going to give you term loan? Term loan, long-term loan, who are going to give, they will worry about this. And those who are going to buy your debentures in your company. They worry about both. Short-term solvency, they worry because of interest rates, regular interest rates. Okay. So there are so many leverage ratios or long-term solvency ratios. First one is equity ratio. Second one, debt ratio, debt to equity ratio, debt to total asset ratio, capital gearing ratio. What is capital gearing? What is gear actually? All of you might be riding and driving car, right? Bike and car. What is gear? Why do we use gear?
Accelerate.
Huh?
Accelerate.
To accelerate? What the? Huh?
Balance.
Balance the speed? To go to higher speed only you need first gear, right? In first gear only you can go to higher speed? No. After going to higher speed only balance the speed consumed. So first gear purpose is using maximum, getting maximum utility, maximum efficiency from the petrol, from the all other needed for riding a car. Same thing applicable here. When will you go in the top gear? Huh? When you ride a bike in a top gear?
When the now particularly you can go for down.
Anybody? When we ride a car, when we drive a car in a top gear? When roads are free, which means without toll. Without toll. Okay, clear road. Clear road. Okay, free. No problem. Sorry? What is that?
The frequent braking.
Okay, not requiring frequent slowing down or playing. Any other reason why we when we go in and come here? There is a person who learned the car only yesterday. Told him that. Will you advise him to go in and come here? What is clear? But road clear is not only the factor which advises me to go in and come here. Okay, right?
When you correct.
So efficient driver. know the logic of the efficient trade. Then urgency is the factor to go and top here. Road is having a traffic. Car is near to you. Don't have license. You have not driven the car before. That's car. Will you go and top here? Urgency. Your condition emergency. Don't be late. Otherwise, your friend has to come to meet you. So that's not a criteria, right? That's the criteria. That may demand you, but it should not listen to that. No clearness, driver proficiency, next. Proficiency, how you can manage. Okay. Maximum level management. Maximum output of capacity. Maximum leverage. Sorry? That vehicle. Condition of the business vehicle. Okay. Now, why I'm telling all these things is, why is it going down here to reach the place very fast with efficient manner? Okay, control. Okay, you are in control. This is going at 20 or 20, 30. Some people going a nice road. Only is 40. New learners will be there, no? Only 40. That's of course demanded because they don't know. But efficiency of the fuel is coming down. So you have reached the fuel efficiency. The same thing applicable here in the gearing. Same word is here. Capital gearing. What is capital gearing? Using more debt capital into your business is called capital gearing. So going to top here. When you get going to top here, your business is established. Board is very clear. Your market is very clear. You have established customers. Okay. Another one is the condition of the environment. Today, there is no business like something called pandemic or something unusual situation, not problem. No unexpected things are expected in the road. Similar to that. So, gearing means a company is called highly geared when it is using more amount of debt capital into its business. This is total capital cycle. Remember capital cycle. I need 100 crore. I borrowed 90 crore. 10 crore only my equity capital. You are said to be in a high geared manner of business. High geared. It is very risky actually. In nice model going 120. What is this? Huh? Let's be there or not. Clear what of the risk is there. Someone will come near to you 140. He may not have control. He may hit. That's all kind of risk in there. So highly geared company is a company which is using more amount of debt capital into its capital structure so that it can generate more profit to its shareholder by paying only fixed interest to the lenders. That is going to be analyzed in this ratio. The proprietary ratio, we have some coverage ratios. Okay, we will discuss one by one all those things.
So debt capital can be also borrowed capital.
Debt capital is nothing but debt means what? Loan. Loan capital, debt capital, borrowed capital, external capital, all. Okay, first one. Equity ratio. Equity ratio is nothing but the mathematical difference between, I mean, the ratio between shareholders' equity and net asset. What is shareholders' equity? Shareholders' equity? Total asset minus liability. Total asset minus. Not only capital invested. We invested capital 1 lakh 2,000. Now the 1 lakh might have been grown to 1 crore. Or might have gone to 10,000. Initial capital invested plus or minus profit earned minus profit drawn back to the owner to his personal. He's not doing all these cyclic, right? Simple thing. Total asset minus the external liabilities is equal to internal liability. Internal liability is nothing but shareholders' equity. Divided by net asset. What is net asset? Net asset means total asset minus fictitious asset. Any fictitious assets are there? That assets. What is fictitious? It has value in the balance sheet, but in real life, no value. Preliminary expense. Okay, issue one, discount and issue of share, discount and issue of venture, something like that. You will in the balance sheet in the name of other current assets. That is called net asset. What the ratio? What is the traditionally it is believed that higher the proportion of owner's fund, lower is the degree of risk. What do you mean by higher the degree of owner's proportion? Total asset is 1 lakh. Owner's equity is only 10,000 means the company is having too much of risk. Your total asset of the company is 1 lakh. But out of 1 lakh rupees per side, how to put money from the owner is only 10,000. I mean 90,000 rupees borrowed and keep it as. So anytime there is a shock in the market, will be so much. Will be so much. Next. Debt ratio, same thing. Instead of this numerator, we are bringing debt. Okay, this debt and equity is to be equal to total capital. Debt capital plus equity capital is equal to total capital. Okay. So now debt capital divided by net asset is equal to debt ratio. Lesser the debt ratio, lesser the debt capital, better the safety to the company. See, look at that. These two things are contradicting each other. What is contradicting each other? Opposite. The ship is made for, the ship is not made for just in the, but to be on the store. Ship is made for what? Sailing. If it is sailing means risk is there. I cannot think, so if we say from this place to that place, maybe some natural calamities, it may sink. If you think that, then that's the purpose of making a ship. If you want to always say, sorry, the seashore only, you can't make any type of operation, any type of problem. In that way, I'm looking to that. Okay, I'm not telling keep less debt. As, of course, keeping less debt is more safe. But how much you are trying to take this? That is good. The management risk. Tata company is acquired by borrowing 10,000 crores, the forest company long time. Tata was acquiring a company called Forest by spending 10,000 crores. The 10,000 crores were borrowed from SBI. 10,000 crores. It's called leveraged buyout. Leveraged person. Meaning that I can manage. How much? Now, Adani Group. People are telling Adani by applying this ratio, Adani Group is so much of poor ratios. All ratios apply standard ratio, they are poor level. Further, we cannot simply say Adani is going to have that. We thought richest person in the world they are living on. But government is bailing out their projects. He is the richest person, but the company is getting some bailout from the government of India. Keep thinking. Next. So you have to decide this based on the situation. General, giving loan to be waived off. Adani companies are getting loans waived off. Adani is getting richer and richer. Okay, so debt ratio, it to be minimum. That should be minimum, but it does not mean that always you have to keep that should be minimum. It is your efficiency, how do you manage your business by borrowing more and more. If market is very clear, market is established, I have also established my standard in the market, I can go borrowing more money so that I can give more benefit to my shareholders. Next, what's the standard method of this much story I'm telling you are not asking. Lesser is the safer. Lesser. Zero by whatever amount is safer. That is nothing but keeping your ship in the shore itself. But that is not the purpose of just one step you are coming into the sea means 0.1 in the numerator. How much it's the captain should decide how much he can take. For that, the only thing how much studies are. We have the captain will only decide. You know, right? The logic. Okay. Market is perfect means market is established. Market is established. Meaning you can have 99% response. But you should be ready for getting any shock also. Because if market is crashing, market I mean to say the goods market. market not shopping. Okay, suppose immediately there is a change in the customer's mind, they don't want to buy your products. And the industry itself is having some problem. Government is studying from tomorrow onwards, we will take this industry in our custody. No more companies. That time all yes, yes. No, this is not the leadership. This is a common phenomenon, right? Low. That's the point. There are any number. Current ratio that will change. Thank you for asking. Current ratio will change. All your liquidity ratio, that is standard actually. The standard will change from ratio by record as your record example, right? That will change. That's why I was telling you from the beginning, don't take only that number and decide anything. Ask for some qualitative data. So that will change. It's industry war. That will change. But this will not change. This is standard, right? Not really the number. Low is safer. High is risky. How much low, how much high? That may change from industry, but the basic will not change. But in a bank is not the same thing, no. Debt capital. Bank borrows money from. No, I'm not talking about that borrowing. Borrowing from the bank also can have to be about this. Okay, bank profitability. Bank's liquidity position may change from industry to industry. Bank industry have different liquidity ratio, but solvency ratios of debt ratio cannot be different. But quantum, the degree may differ. Lower is safer than never change for any industry. Higher is risky. Next. Debt to equity ratio, very important ratios under solvency ratios. Debt to equity ratio. For the proportion of debt to equity, out of 1 rupee of my capital, how much is made out of debt, how much is made out of equity? That is being measured in debt to equity ratio. The formula is long-term debt divided by shareholders' equity. In the previous two equations, what was the numerator? The two are taken and it is framed this formula. Debt by equity. The first one, equity by net asset. Second one, debt by net asset. Here it is debt by equity. Debt capital divided by equity capital. Suppose here 1 lakh is a debt capital, 2 lakh is equity capital. What the ratio will be? 1 lakh debt, 2 lakh is equity. What's the ratio? 1 by 2. 0.5 is 1. 0.5. 0.5 is what? 0.5 is debt. Okay, it can be 1:2. Maximum. Somebody asks maximum means you can say 1:2. But because from industry to 1 rupee I have, I can borrow 2 rupees. Simple rule of thumb. You have 1 rupee, you can borrow 2, double the time. But if you borrow 3, 4 points, that's dangerous, not risky. Dangerous. You should have calculated risk, not about entering into dangerous zone. Okay. But how quickly you are replaying that matters. This will change, you know. Industry is a standard changes. But real fact will change from yesterday. Debt equity ratio will be 0.5:1. Tomorrow my debt equity ratio will be 0.75:1. Meaning I have borrowed some more capital, more debt. Okay, next time it will be 1:1. I am borrowing still more. Another time it will be reducing or repaying. It's changing from time to time. Next, fourth one, debt to total asset ratio. Debt to total asset ratio, that's equal to outside liabilities divided by total asset, or total debt by total asset. Total asset is the denominator. Total debt divided by total asset. So comparing the relationship between the total asset with total debt capital. How much asset has been created out of debt capital? That is being captured. If my total asset is 100 rupee, out of 100 rupee, how much I borrowed? That's what numerator. Okay. What is the standard here? How can you decide the standard here? Total debt is 5 rupee. Total asset is 10 rupee. What's the ratio? 0.5:1. So lesser the ratio, better the safety. Lesser the ratio, better the safety. Next. Capital gearing ratio. Capital gearing. It studies the relationship between the fixed interest bearing securities and the equity fund or net worth. Equity fund is nothing but net worth. Okay. The formula is total capital divided by equity. The numerator is total capital, preference capital, debentures, and then other borrowed funds. Okay. Fixed income bearing securities. You can write here is nothing but we call this as fixed income bearing securities. Fixed income bearing securities. What is this fixed income bearing securities? You take money from somebody by issuing some document. The document is called security. Security means, in this context, security means any paper that gives you a right to claim some amount on somebody else, and it can be traded in the market. It's called securities. You are borrowing loan from a bank. You are taking money from deposit holders. You take money from preference shareholder. All these people will not worry about your profits. They need a fixed rate of return. So 5%, 6%. Normally it is less. Normally the rate of interest will be less because they need profit, irrespective of the profit or loss. Okay. So all those capital which you borrowed from people for a fixed rate of interest divided by the net worth of the company. Net worth. Equity share capital plus reserve means what? How much you earned so far in the company minus any losses. Okay. It's nothing but net worth. Net worth. Shareholder fund. Equity shareholder fund. Now, what is the interpretation you can give? This should be minimum. The numerator should be minimum. How much possible minimum? Well, safer. If you are increasing that, you are getting into financial risk. There are two risks for a business: financial risk, business risk. Business risk is associated with the business condition, raw material purchase, operation, how the demand for the products, all those things are called as business risk. Financial risk means how are you managing your money from borrowed money? Are you able to repay the interest or not? That's not financial risk. If you increase this amount, suppose these amounts are more, say for example, 2 lakhs divided by 10 lakhs. What's the ratio now? 2 is the numerator, as if 2 is the numerator. 2 lakhs divided by 10 lakhs. What is the 2 by 10? 2 lakhs by 10 lakhs. See what that? Okay, sir? Fine. One time of your net worth is represented by. Look at this. This is until this is how much? This is how much? 10 lakhs. This is what will I told you? 2 lakh and 10 lakh. 2 by 10 is equal to 1 by 5. So 1 time of your net worth, your borrowings. Total money is 6 lakhs. Out of 6, 5 is your own. 1 is from outside. No risk. Not good or bad. Less risk, more risk. See, good or bad is subjective. For me, I have a passion of borrowing more. Somebody is borrowing more. Put your ticket in advance, you apply. To any country, it is not traceable by certain also. Okay, or they will go to Kailash. Where they will be safe. Good or bad is different, but less risky, more risky. Proprietary ratio. This is very, very important ratio in ratio analysis. Proprietary ratio is nothing but a relationship between proprietary fund and total asset. What is proprietary fund? It includes equity share capital, preference capital, and resources surplus. Total capital, except borrowers. Okay. Proprietary fund means owner's fund. Owner's fund is nothing but total fund minus borrowed is equal to proprietary fund divided by total asset is equal to proprietary ratio. What is the interpretation you can take? If proprietary fund is 10 lakh and the total asset is 20 lakhs, 10 by 20 is equal to 1:2. If it is there, what is the interpretation you can take? Proprietary fund is 10 lakh and total asset is 20 lakhs. Double the time of your own capital is represented by total asset. Total asset. It's not good. Risky. Okay. Like this, you can test the company's long-term solvency. See, you can ask me a question, sir. There are so many ratios are there. Okay, which one I have to take? If I want to take one number, we are all in that category, right? You want, sir, one, tell me one, yes or no. Like that. For that, these are all to be grouped into one particular formula. We have a concept called DuPont analysis. It's not there in our syllabus. DuPont, DuPont, the company name. DuPont, DuPont analysis. We can use that for our assignment. Okay, DuPont analysis. What does it mean? We have bits and pieces, all these standards, all these numbers, all these ratios. Here and there it is there. So many ratios are. I want one number, that is more than one or less than one, so give me one number. 40 is the real efficiency. Don't go less than 40. Go more than 40. The 40 is the real efficiency. Let me like that one parameter. That parameter is coming in DuPont analysis. Okay, DuPont is a company. They invented that long ago. So they are using this. Okay, DuPont analysis. And one more thing is Altman result score. We have another logic called Altman ALTO. So ALT, MON, Altman, MAN, Altman Z score. Altman Z, the letter, English letter last alphabet. Z score. You would have studied something in the statistics that score, not that score. Another way. What is that score? Okay, based on the discrete analysis, this professor by name Dr. Altman has found out the logic of one single number to decide about the bankruptcy of the company. Bankruptcy. The company is about to bankrupt, or already bankrupted, or the company is sold. Long time is there to reach bankruptcy, or no way to reach bankruptcy. Ultimate is a just browse your free. A concept called ultimate is a core. He's a professor. He found out a logic by applying some statistical measures or discrete analysis. What equation is there? But all these ratios based on this ratio, he needs his ratio by applying these ratios in an equation. By taking these numbers in an equation, he is finding out one number. That one number is going to decide whether you are into bankruptcy or about to bankrupt or you are sound. He is having 4 categories. Okay, sound. Okay, somewhat sound. About to bankrupt. Like that we are. We have time. Next class we will discuss. But we just decide that to browse about this. Your second assignment is on. To find out 2 point is same logic only. He is having a little lesser way of finding out the entire phenomena of single number. Based on this, by keeping these numbers, we can do something. Okay, let us close it. Another 10 minutes. Okay. Yes, 10 minutes. So next, third category is activity ratios or efficiency ratios. Under this, we have 5 subcategory. Yeah. Coverage ratios. Coverage ratios. Simple. Only one thing. Coverage ratio means how much your profit is going to cover the fixed input charges. You are comparing your fixed input charge with profit. You cannot expect a question, but it is there in the PDF. You can refer later. Next, first one is total asset turnover ratio. Under third category called activity ratios. Total asset turnover. The name itself is telling you asset turnover. What is asset turnover? Asset compared with turnover. Turnover by asset. The formula is turnover by asset. Turnover means sales. Some author in this book also they applied like that logic. Sales includes profit also. I would understand. If I'm selling this pen for 10 rupees, it means cost what I spent for this pen plus profit what I expected. Simple 10 rupees. So people are telling the profit is only what I expected. So you remove. If you remove profit, you get cost of goods sold. in the data, if it is given cost of goods sold, but balance sheet will not have clear record, will not be having cost of goods sold. You have to take only sales. Because the formula is given there. Either sales or cost of goods sold, depending upon the data availability, divided by assets. Divided by total assets. Okay. So what is the interpretation? Higher the higher the ratio, better the efficiency. In all these group of ratios, you are measuring the efficiency. You have to say in terms of efficiency. Now take an example number. Sales is 20 lakhs. Assume sales is 20 lakhs. Total asset is 2 lakhs. What's the ratio? Total sales is how much? 20 lakhs. Asset is 2 lakhs. What's the ratio? 20 by 2. 20 by 2. 10 by 1. 10. So 10 times. One asset is able to make 1 rupee worth of asset is able to make 10 rupee worth of sales. Another company, 10 lakh, 20 lakh rupee sales, 20 lakh sales. Their asset is 10 lakhs. What's the ratio for them? 20 by 10. 2 times. It's not 2:1. We will tell number of times. 2 times. What is 2 times here? 1 rupee of asset owned by that company is able to make a sales of 2 times. There it is 10 times. Which one is better? 10 times is better. Higher the ratio, better the efficiency. How we are doing that logic? The proof is in this example. 1 rupee is able to make 10 rupee of sales. Another company, 1 rupee is able to make only 2 rupee of sales. So they are not able to manage the asset efficiently. Lesser the ratio, poorer the efficiency of the management. Better the ratio, higher the ratio, better the efficiency of the. Okay. Next, fixed asset turnover ratio. Same logic. Here we have taken all the assets, total assets. There we are going to take only fixed assets. Same thing. Only the denominator is going to change. You are going to minus current assets from total assets. To apply fixed asset turnover ratio. Logic also same. Higher the ratio, better the efficiency. Clear? Fixed asset turnover. Asset turnover. Next one is fixed asset turnover. Third one, capital turnover. Capital turnover ratio. Net asset turnover ratio. What is net asset? Total asset minus fictitious asset or any other waste asset. In the first one, we included all the assets, total assets. Now it is total asset minus any fictitious asset. Okay. Logic again same. Higher the ratio, better the efficiency. Look at this. Higher the ratio, better the efficiency. Higher the ratio, better the efficiency. You are utilizing your asset more. Okay. Next. Current asset turnover. Same logic. Instead of fixed asset, instead of net asset, instead of total asset, you take only current asset and comparing with sales. What is the efficiency of current asset towards sales? 1 rupee of current asset is generating how much amount of sales that we are measuring here. Okay. What is the interpretation? Next, stock turnover ratio. Stock. You remember now, slowly we are coming to one item. Turnover is common, and we are comparing the turnover with so many different components of asset. First, total asset, net asset, current asset, fixed asset. Now only one asset, that is stock. Stock is one current asset, not the current asset. So stock turnover ratios. The formula is cost of goods sold, otherwise sales, divided by average stock. Average stock means opening stock plus closing stock divided by 2. How do I know opening stock? Last year balance sheet. How do I know closing stock? Current year balance sheet. So that divided by 2. Debtor turnover ratio. Another component of current asset is debtor. That is compared with sales. Debtor turnover ratio is equal to total credit sales divided by average accounts receivable. Accounts receivable means sundry debtors, bills receivable, accounts receivable, all together. Okay. Is it clear? This comparison. Only credit sales you have to take. Why are taking credit sales? Debtor is result of credit sales only. If you take cash sales, they're just giving and going. That's all. Okay. Next one, how quickly you are able to collect your money from debtors. That is being measured in terms of one ratio that is called average collection period. How many days you are waiting to collect your money from the debtors? That is being measured in one ratio called average collection period. What is average collection period? Total number of days in a year, or month in a year, or weeks in a year, divided by debtors turnover ratio. You already computed debtor turnover ratio. Okay. It will give you the number of months if you take in months. If you take in weeks, it will give you weeks. Answer will be in week. Okay. What is the interpretation for this? If you have this answer, for this you have an answer like 12 months divided by 2 is equal to 6. Another company is having 12 months divided by 12 is equal to 1. Which company is better? You are taking 1 month as an average period to collect money back. You take another case, 6 months to collect back your money from debtor, which is good. 1 month. So lesser the average collection period, higher the efficiency of the company. Lesser the collection period, higher the efficiency. When you can have less collection period, what is the relationship between collection period and the receivable turnover ratio? 12 by, I told you 12 by 2, I told you 6. 12 by 12 is equal to 1. 12 is nothing but number of months in a year. Divided by 12 means 12 is the receivable turnover ratio. So 12 by 12 gives 1. 12 by 2 gives 6. So which is the best for receivable turnover ratio? Lesser the turnover ratio or better the higher the turnover ratio? 12 by 12 is equal to 1. 12 by 2 is equal to 6. So higher the receivable turnover ratio, better the efficiency of the company. So higher the receivable turnover ratio will give you the lesser collection period. 12 by 12 is equal to 1. 12 by 2 is equal to 6. Next. Similarly for creditors, how you are paying to your creditors? Payable ratio. Okay, payable turnover ratio. Average credit purchase divided by average accounts payable. What is credit purchase? Total purchase minus cash purchase minus purchase return is equal to net credit purchase divided by average accounts payable. That means opening creditor plus closing creditor divided by 2. Okay. Similarly, you can calculate the average payment period also. Total number of days in a year divided by creditor turnover ratio. Payable turnover ratio is nothing but creditor turnover ratio. What is the interpretation? Interpretation. Payment collection period you told lesser the better. Here it is higher the better. Because you have to pay. No, meaning it's not delaying. It's not measuring you how much you are delaying. It's measuring how much you are enjoying for the creditor. He himself will tell you, while giving the invoice itself, he will tell you within 45 days you have to make the payment. If 45 days are crossing, this is penalty. Within 45 days, 10 days with the discount, 15 days, 25 days, this much is discount, he will tell you. So that how much you are enjoying. That's it. We'll close it. Another one. This is there in your LMS. Need not to write verbatim all the formulas. Understand the logic. Last one, profitability ratios. Group of ratios, profitability. Okay, first ratio is gross profit ratio. Gross profit ratio is the first one under the group of profitability ratios. Formula is gross profit divided by sales into 100. These profitability ratios are expressed in terms of percentage. So all the formulas will have multiplied by gross profit divided by net sales into 100. Higher the gross profit ratio, better the efficiency of the business. Higher the profitability. Okay. Next. How do you know gross profit? Sales minus cost of goods sold is called gross profit. Net profit ratio, net profit by net sales into 100. Net profit you can get it from profit and loss account last time. Net profit. Sales you can get it from profit and loss account first time. Okay. Into 100. Higher the profitable net profit ratio, better the efficiency of the company. Operating profit. What is operating profit? Profit earned from operating activity. What is operating activity? Core activity of the business. Selling a land and getting a profit is not a profit of the operating activity, but it's a profit. That profit is just a net profit, but it's not coming from operating activity. So operating profit is equal to net profit plus non-operating expenses minus non-operating income. If your net profit includes some amount of non-operating income, you have to minus it. If your income already considers some non-operating expenses, you have to add it back. Don't wonder that why are you adding expense? It is not a business operating expense, but it was already minus from my profit. So I'm adding it back to get the operating profit. So such operating profit divided by net sales into 100 is equal to operating profit ratio. Higher the operating profit ratio, better the efficiency of the business. Expense ratio, you take any expense divided by sales is equal to that expense ratio. Lesser the expense ratio, better the efficiency of the business. Clear? Any expense, COGS, operating expense, operating ratio, anything can take. Okay. Last, this one will conclude. I think we are already crossing time. Return on investment, ROI. First example I told you, remember? Return or profit divided by investment into 100. Higher the return on investment, better the efficiency. You can compare your own ROI with your own ROI of last year. You can compare your own ROI of current year with your rival company's ROI in the current year. If you compare yourself with your rival company or same company, same industry, another company, that's called inter-firm comparison. Inter-firm. If you compare yourself with yourself in the different time point in time, that's called intra-firm comparison. Okay. So remaining, I think you can go through this. It's not that difficult. I would like to tell only one more ratio, which may be very interesting for you. Yeah, this one. Price earning ratio. If you are buying a company's equity share, if you are buying a company's equity share, you have to look at this ratio. Price earning ratio. What is price earning ratio? How much is the market price you are spending today to buy a share, divided by how much you can get from that company's equity share as EPS. EPS means earning per share. What is earning per share? Net profit after tax divided by, okay, before that, net profit after tax minus any dividend payable to preference shareholder. If anybody is there, our company may not have. If it is there, you minus that dividend. Remaining amount is there. That much is divided by number of equity shares is equal to earning per share. Earnings available to equity shareholders divided by number of equity shares is equal to EPS. So how much you are going to get as EPS and how much you are spending to buy the equity share. Today, Infosys carry or buying 1,200 rupees you are spending, buying, waiting for 1 year. How much you are going to get as EPS? EPS means you are not getting in hand. May come to you or it may be detailed in the company itself. Okay. So what is the percentage of that? That is being measured in price earning ratio. Suppose example, 1,000 rupees you are spending to buy a share. Company A share you are going to buy by spending 1,000. You are going to get EPS as 100. So what is the ratio? 1,000 by 100 is equal to 10 times. 10 times. 1,000 by 100. Another company, same 1,000 rupees as your price, the EPS is going to be 50 rupees. 1000 by 50 is equal to 1000 by 50 is equal to 1000 by 50 is equal to 20 times. So which company is better now? Which company will invest? So 20 times you invest? No. Lesser the price earning ratio, better the company's performance. Forget about ratio, take a number. 1000 is spent for both the companies. First company gives you how much? 100. Second company gives you only 50. Which is better? First one is better. For the first one, what is the ratio? 10. For second one, what is the ratio? So lesser the price earning ratio, lesser the P ratio, we call it as P ratio, P bar. Lesser the P ratio, better the performance of the company. In terms of equity shareholders fighter. Okay, so with this, we can conclude today's ratio analysis. I request you to go through this same PDF file and work out with numbers. We just talked in theory and we understood what are the ratios, what are the interpretation for that. Now we need to have numbers. Why I'm not telling that in the class itself? Calculation we can do on today's work, calculation is done in automatic, software or in Excel or in some of the physical. Okay, so but in exam we are not going to do that. We are going to make a manual calculation. For that purpose, we just prepare all the questions in this particular PDF file. And keep in mind, I upload the assignments whenever 2 days. You have to perform ultimate result score analysis for minimum 2 companies. 2 companies belonging to the same industry. It may be current company, current year data, or you will check any data of any company which is already bankrupt. Some years ago, that was bankruptcy. I want to check the efficiency of the ultimate. He's telling I have a scale to measure. You can measure a company is already running. You can say good or not. Or else you can take the same scale and you can compare with the, measure the dead company. Why the company died? This is the same measurement what ultimate told is right up. Equal to. Okay, I'll explain that in the next class. This time also in the LMS. Okay, thank you so much. See you again.
Thank you, sir.
Those are online, any doubt?
No,
So please do all these questions in this PDF file. It is available in your LMS. If you have any doubt, we can discuss in the next class after solving the problem. Thank you so much. See you again.
Thank you, sir.
thank you, sir.
Thank you, sir.
Some shareholders